Buoyed by high interest rates and the reopening of economies that have led to more spending, the good times keep coming for DBS, UOB and OCBC. The trio of banks have also posted growth in net interest margin. NIM is a key measure of a bank's profitability, measuring the amount of money a bank earns in interest on loans compared to the amount that it's paying out in interest on deposits.
So now all the banks expect the net interest margin to go above 2%, which it really happens to went above 2%. So with all this net interest margin, the banks expect to have a more higher quarter.
But those higher interest rates that have boosted profits could also impact loan growth. And with the Fed expected to slow the pace of interest rate hikes this year, analysts expect bank earnings to continue to grow, but at a much slower pace.
So what this means is that it really brought the question of whether we are heading nearer and nearer towards seeing a peak in terms of the bank's net interest income portion, because the tailwind from this rising interest rate environment may not be as robust as what we have seen over the past 1 year. So that is something the banks will have to deal with. And in terms of the deteriorating growth outlook, I think loan demand could still run the risk of seeing further moderation over the coming months.
While asset quality remains resilient for now, analysts also will be watching non-performing loans closely. Fitch Ratings has said it expects some asset quality worsening in 2023, given the time lag before rising rates affect repayment ability.
We are having interest rates at a very, very high level. Input costs defined by inflation is also quite high. So for a lot of companies, this is actually a very tough period to operate in. So I think as we go forward, particularly for the banks, the net NPL side, the non-performing loan side, will most likely will start to rise. So far, we haven't really seen that impacting in the fourth quarter results, but that is something that we are concerned about.
Another downside risk is a sharp deterioration in the global economy, which could weigh on investment banking activities. On the bright side, China's reopening is seen as a major growth opportunity for the big three banks.
The other area to kind of look at is actually non-interest income, particularly wealth management. That has actually been under quite a bit of pressure over the last few quarters, given interest rates are high, market conditions are volatile. But at the same time, we've seen inflows in terms of AUM still growing for the Singapore banks. In DBS's case, just in fourth quarter, they still had around $9 billion of inflows. So there's a lot of dry powder, which as market conditions start to, if you start to see market conditions getting into a little bit more of a predictable level, that's a lot of money that can be put into work.
All three banks have also expanded their footprint across Asia in recent years, putting them in good stead to benefit from regional growth. For instance, UOB's acquisition of Citigroup's consumer business in 4 ASEAN markets, which it expects to be a main growth driver this year.
I think our 3 local banks are in a very sweet spot to benefit from this growth across the Asian region. So over the past 1 year, we have seen strong acquisition plans coming from DBS and UOB, for example. So I think kind of moving beyond their home market, which is Singapore, kind of allows them to tap on these larger or even higher growth markets to drive longer term sustainability in terms of their earnings growth.
That's why for investors, these blue-chip bank stocks remain a good defensive position to have in your portfolio, even if they don't come cheap.
I think you should still remain invested in the banks. If you look at globally, we are still seeing significant amount of volatility. We've got geopolitical risks. We still have a lot of uncertainty on what the central banks will do. Markets are quite volatile. So the Singapore banks actually offer quite a defensive positioning through all that.
I think if you look at all 3 banks, they are all trading above their 5-year historical average in terms of the price to book valuation. But if you were to look at it from a dividend standpoint, I think then that will warrant more of a buy. I think just based on this consistency of their dividend payout, even during times of previous economic downturns, So I think the three local banks have been living up to their reputation of being a very steady dividend play that one would like to have in their investment portfolios.
And while you can bank on these stocks for a steady dividend, investors have to also monitor yields as they come down eventually, and then decide if there are alternative, risk-free investments such as T-bills to keep your money in.
As long as the book value hits 2 times and the dividend yield start to drop below 3%, I think that's a very big concern, because it means that a lot of people are getting into the market, into the bank, and that's going to be quite overheated. So I think that is a time where we need to look whether there's other alternative, safer investment to exit out, to transfer to.